How dovish was that?
I think it was dovish enough. I think the most important comment he made was really making sure that he answered Steve's question on the autopilot and what that meant, and referring that back to the base case. And as long as that's based on their base case assumption and not on whatever happens in the future, that was, I think, the key for the market, knowing that that's not just autopilot no matter what.
So if that's the case, why aren't we seeing a bigger rally?
Well, I mean, I don't know, Sarah, probably trading volumes are a little bit lower today, but the other thing is the market's still going to be cautious. It's not just the Fed that matters. There's a lot of things that matter in this market today. And so I think it's one data point, one that we'll look at, and the market's going to be cautious about a lot right now.
Anthony, let me get your thoughts on what you just heard out of Williams as well.
This is a real magnificent speech and much different from what most of us are accustomed to. I remember working at the Federal Reserve in Washington when Paul Volcker was there, and as an economist at the New York Fed when Greenspan was there. And John Williams brought his Fed thesaurus to the table. And that, I think, really soothed the market. In terms of the reaction, you had almost a 20-point jump or swing in the S&P 500 index. That's pretty significant. And again, why is the market reacting this way? Very clearly, the concerns of the market was, what is the Federal Reserve going to do with the Fed funds rate in 2019? John Williams told us everything is on the table. They can adjust that path. Then, of course, the markets are really worried about that autopilot situation on the balance sheet. Once again, John Williams says even that is on the table, that if things were to shift, the Federal Reserve would be flexible on that. So almost on all fronts, the Federal Reserve is telling us they're listening to the market. John Williams took the time to tell you that people on the Federal Reserve, and certainly when I was there, they did it, but he told us today, they're watching the markets, they're talking to people, they're using soft data, they're using the hard data. In other words, if people think that the Federal Reserve is tone deaf, today John Williams told them that is simply not true, and that's why you got the positive reaction.
But Ann, nothing he said just now contradicts or unwinds what Powell said on Wednesday, including the balance sheet stuff.
Well, I really don't agree with that, and the reason for that is the market reaction was Jerome Powell is set in his ways. They're going to raise interest rates. Maybe they'll adjust it a little bit. Instead of 3, they may do 2, but they feel the economy is very strong. And what John Williams said today, President Williams said today was, yes, that is the baseline estimate, but if things weaken, and that's all the market wants. Remember that when the economy is doing well, guess what? You're on bullish drive. The markets don't need dovish talk. But all of a sudden, if you're approaching bearish drive, that is approaching bear market territory, we're not there yet, Carl, that's when the market wants a more dovish Fed. And today, John Williams told us, if you approach bearish drive, where you get into bear market territory, where the S&P 500 drops more than 20% or more, guess what? We are listening and we are ready to adjust. That was the message, and that was different from what the market got out of Jerome Powell's news conference and certainly statements.
So, Ann, what does that tell us about Fed communication under this current Fed chairman, and whether the market can put faith and credibility in him if Williams, one of his lieutenants, has to come out and sort of soften his message and recalibrate the tone?
Hopefully it means that he realizes that words do matter, and looking at a thesaurus and explaining what those words mean today is one thing, but thinking very carefully ahead of time about what words you use with the market, I think, is very important. Longer term, actions are what matters, right? And so when the market is as nervous as it is, what it was looking for is the Fed to say, we have your back. And when things get bad, we'll see if they do. And so I think words do matter. Saying we have your back gives people a little bit of comfort now, but the market will want to see it. And I think what we heard is they're paying attention. It was just semantics.
Right. I do want to contrast. I think we have a soundbite from Williams talking about the balance sheet. And bear in mind, this compares to Powell's answer to a question on Wednesday saying that the balance sheet would essentially be on autopilot and that rate decisions would be the focus of any changes they could make. Here's Williams.
Are you at a point now where you think the plan as laid out to the markets to reduce the balance sheet should be reconsidered?
Not at this point. I think the economic outlook, again, is very strong, and I am personally of the view that we're on the right path. I obviously strongly supported our rate hike at a recent meeting. I don't see the need today to change our balance sheet normalization.
All right, so Anthony, I mean, I guess we're just trying to put into context for viewers, how much of a pivot is that?
I think it's a significant pivot because the economy weakens. And another thing that we didn't talk about this morning is the fact that President Williams talked about financial conditions. If you look at the Chicago National Financial Conditions Index, that has actually deteriorated for 13 consecutive weeks, where you've seen that index moving closer and closer towards positive territory. Whenever that index moves into positive territory, bad things happen. You get bear markets, and you certainly get recessions. And so when you see that kind of deterioration in the financial conditions index, that is, in fact, put out by the Federal Reserve, John Williams is going to be listening. He told us that this morning, and that certainly will be reflected in terms of adjusting that autopilot with the balance sheet.
And I think it's a good sign that they say they're listening, but I think what some investors are concerned about really is that they're getting the wrong message. When they say that the outlook is strong and the economy looks good, why aren't they referencing inflation expectations, which have been falling pretty sharply? Why aren't they referencing CEO confidence surveys, which have completely rolled over, along with some of the other soft data like the Philly Fed and the New York Fed? That's not an economy that's picking up steam.
I think they're trying to carefully balance things, Sarah. What you don't want is a Fed to come out and be so dovish and so cautious that it scares the market more. And so I think they see the same data that we see. The market's reacting to it. They had this rate hike that they were going to do. I think going ahead with that was fine. I think the rest of the market would have been fine with it too. It was more the semantics about what they said. That being said, I really do believe they're focused on quickly changing any base case scenario that they have if the things in the economy change. And so they're going to wait and see. There's a lot that could happen. You know, if you get a China deal, you could see global growth start to turn up again. And so I think what they're saying is there's just a lot of things in place, and they're just watching carefully.